What's up, everybody? Gabe with Persistent Trading Group. Today, I'm going to talk about my favorite trading strategy, which is supply and demand. So, I'm going to break it down for you guys, how to use it, how to spot it, and how to take trades using it. So, first of all, what supply and demand is. Pretty much when we have movements in the market, we move in trends. So, we have, uptrending market and a downtrending market, and sometimes we move sideways, which is called consolidation. So, for example, here we have an example of a downtrending market. So you see we make a high, we make a lower low, we make a lower high. Here we have a higher low followed by a high at the same price area where we reject and then move on to make a lower low. So pretty much when we're using supply and demand levels, we're looking for areas where we may have a rally or a big drop of price followed by a consolidation level before rallying again or dropping in price again. So for example, here we have a consolidation level followed by a big move down. So this is how we would draw that out. We take your rectangle right here, and then we can use this candle before the big drop to signify the consolidation candle. So then we simply draw that candle out, and then we wait for price to come back and test that supply level. So we move down, we come back, we test that supply level, and then we move down again. The idea behind this is when we have those big drops or big rallies in price, it's caused by institutional orders. Retail traders can't move prices in the NASDAQ with the money that retail traders have. You need big money coming in on those sells or on those buys to move the NASDAQ at that speed or at that big of a price, you could say. So the idea is when we have these big moves down, these institutions are getting sell orders filled. So the idea behind it is once we re-enter this zone, all the sell orders that didn't get filled on the first drop will now get filled on the return to that price level, which will then cause it to come down again because we have all the big amount of money going into the sells. And it's just the opposite the other way. Same idea, just now we have buys instead of sells. So one example of how this works for the buy side is right here. We have this move down followed by this consolidation before a rally. So this consolidation before the rally is now going to be a demand zone. So we're going to look for price to come back and touch this before rallying to the upside, and that's exactly what it does. Right here we have the consolidation levels where we drew our demand zone. We saw a big move down into demand before we saw a rally back up about 120, 140 or so points before coming into the supply zone up here and then having a huge drop. So that's an example of how it works to the upside. Now, when we take these trades, this is the 1 hour chart. So usually we're not going to take these trades on the 1 hour chart. Let's see how we would take it on a 15-minute chart, which is more realistically how we're going to be trading this. So you can see right here we have our consolidation level that we mapped out on the 1 hour chart. We see this drop into the demand level, and then we see green candles. So once we get above the top of this red candle would be a good time to enter once we see the stock start to move up or start to rally or start to move above where these sellers came in on this big candle. Usually when we're looking for a price point to take profits at, we'll look for a supply zone. Now, here there wasn't much of a supply zone until up here. So you can just take this rally and then start taking profits on the way up. And once you see this sideways movement start coming in, then you get out of the full position. So that's pretty much how to use the supply and demand zone. If you have any questions, leave it in the comments down below. And that's all for this strategy.